I want you to forget everything you think you know about the market manipulation of precious metals. We are standing right now, at this very moment, on the absolute precipice of an economic and financial event that will be studied in history books for centuries, an event that will instantaneously redefine the fundamental value proposition of one of the world's most critical commodities. This is not hyperbole designed to grab your attention. This is the cold, hard conclusion drawn by one of the most respected, most dedicated, and most successful physical metal advocates in the history of finance, Sprott. His words are not merely a warning, they are a prophecy that hinges on the timing of a single systemic failure, and that failure, he suggests, could begin tonight. The claim is stark, audacious, and absolute. Tonight could trigger a change in the price of silver for eternity. What precisely does that mean? It means we are looking at something far greater than a temporary price spike due to geopolitical tension or seasonal inventory adjustment. We are discussing the permanent decoupling of the paper price, the synthetic, fabricated illusion of supply that has held this metal down for decades, from the actual, irreplaceable, and rapidly depleting physical reality of silver itself. This shift, once initiated, cannot be reversed. It's the final checkmate in the long-running battle between the physical stackers, led by visionaries like Sprott, and the centralized banking entities that utilize the paper derivatives markets to suppress true discovery of price. Let's establish the foundation quickly, because time is rapidly running out. Silver is perhaps the most undervalued asset on the planet today, primarily because it serves two masters. It is a time-tested monetary metal, a store of wealth that has been recognized for millennia, but it is simultaneously an indispensable industrial metal. This duality is its great strength and, ironically, the reason for its aggressive suppression. Consider its industrial applications alone. They are staggering. Silver is required for solar panel photovoltaic cells, for nearly every electrical connection in electric vehicles, for medical applications, for 5G infrastructure, and for almost every high-tech electronic gadget you own. Unlike gold, which is mostly hoarded and reused, a massive percentage of the silver consumed by industry is permanently destroyed or scattered in landfills, making it non-recyclable economically. We have a systemic supply deficit. Every year, the world consumes significantly more silver than is pulled from the ground. This deficit has been persistent, deepening year after year. Logically, under natural market forces, this situation should have propelled silver prices into the hundreds, if not thousands, of dollars per ounce years ago. But that hasn't happened. Why? Because the price is not set by physical supply and demand. It is set by the derivatives exchange, specifically the COMEX, where staggering volumes of synthetic paper-silver contracts are traded every single day. This is the central conflict, the mechanism that Sprott believes is moments away from catastrophic failure. The banks are operating on a massive fractional reserve system for silver. They promise physical delivery that they simply do not possess. For every physical ounce they hold in their registered vaults, the ounces available for immediate delivery, there are hundreds, if not thousands, of claims against it in the paper market. It's a massive IOU scheme, functioning only on the collective belief that no one will ever ask for their physical metal all at once. And this, right here, is where the tension mounts, where we need to look closely at what Sprott is observing. He isn't worried about the price of silver. He is laser-focused on the inventory of silver, specifically the registered category on the COMEX. The registered inventory is the lifeblood of the paper market. It is the available buffer that prevents a formal default. When that inventory drops below a certain critical threshold, a level many analysts argue we have already functionally crossed, the banks lose control. They can no longer manage the flow, and a panic ensues. The market flips from being a system controlled by paper short sellers to a system dominated by physical demand. Before we dive deeper into the terrifying numbers surrounding the COMEX vault levels, please take a quick second, pause this narrative, and hit that like button. It signals to the algorithm that this critical, time-sensitive information needs to be seen by everyone who still believes in honest price discovery. And if you haven't already, subscribe to the channel and turn on notifications, because the next segment will reveal the explosive details of the trigger itself. Sprott's analysis is fundamentally about exhaustion. He sees a system that is bleeding out. Major entities, large institutions, and sovereign wealth funds are finally waking up to the reality that they own worthless paper receipts instead of actual metal. They are now actively demanding physical delivery, draining the COMEX vaults at an accelerating, unsustainable pace. The paper market is so thin, so exposed, that it only requires one major player to stand up and demand a significant physical payout, say 10 or 20 million ounces, to expose the naked short positions of the major bullion banks and trigger a force majeure event. Let's talk about the gold-to-silver ratio for a moment, as it underscores the absurdity of the current pricing structure. Geologically, silver is mined at a ratio of approximately 8 or 9 to 1 against gold. Historically, the ratio was often pegged around 15 or 16 to 1. Yet, the paper markets have kept this ratio artificially inflated, often far exceeding 70 or 80 ounces of silver required to buy a single ounce of gold. This staggering disparity is prima facie evidence of manipulation. Sprott believes that once the physical constraint hits, the ratio will violently snap back towards its historical average, meaning silver must appreciate exponentially faster than gold. The key question then becomes, what is the specific event that Eric Sprott is suggesting could happen tonight? It's the physical delivery deadline against a massive open interest contract. The market makers and short sellers have consistently managed to roll these contracts, settle them for cash, or coerce the buyers away from physical delivery. But the buyers are getting smarter, more sophisticated, and frankly, more desperate for tangible assets in a world awash in fiat currency and debt. Tonight, we may witness the critical mass of physical demand coinciding with critically low registered inventory. Picture this scenario. A major institutional investor, maybe a fund representing billions in assets, holds a very large futures contract. Instead of rolling it over or settling for fiat, they declare, "We want our metal." Really, if that demand exceeds the available registered inventory, a number that has been dangerously hovering near levels that have historically caused market seizures, the COMEX structure instantaneously breaks. This is the tipping point for eternity. If the paper structure defaults or even unilaterally changes the rules to prevent physical delivery, an act of blatant admission of insolvency, the paper price becomes irrelevant overnight. The true price discovery then shifts entirely to the over-the-counter, OTC physical markets. Suddenly, instead of banks selling synthetic silver at $25 an ounce, industrial users, the solar manufacturers, the 5G developers, the EV producers, will be scrambling to find actual bars, and they will be competing against monetary buyers. They must have the metal to continue production. Their willingness to pay will reflect the true terminal scarcity of this metal. This isn't about moving from $25 to $30. This is about establishing a new pricing floor based on industrial replacement cost and true scarcity, a floor that could be multiples higher. This structural break guarantees that the price of silver will never again be dictated by the centralized paper game. Eric Sprott, through his actions and his warnings, is signaling that all the ducks are finally lined up for this permanent shift. The inventory is too low, the demand is too high, and the confidence in the banking system's ability to deliver is non-existent. The outcome of this is not merely a profit opportunity, it is a fundamental preservation of wealth against systemic financial collapse. The implications of this breaking point, this moment of truth that could be triggered tonight, extend far beyond the vault, affecting industrial output, inflation metrics, and the stability of the global monetary framework itself. The immediate consequences of a physical silver default are enormous, creating cascading failures throughout the commodities world. We are talking about a liquidity event that will shock markets globally, forcing re-evaluation of every asset class priced in fiat. The market is currently blind to this impending physical scarcity, blinded by the smooth daily operations of the paper exchange. But Sprott sees the fracture line running right beneath our feet. If you're finding this analysis compelling and want to ensure you are completely prepared for the inevitable, please take a moment to subscribe right now and share this video with 3 people who need to understand the true state of the silver market. We have established the tension, defined the conflict between paper and physical, and focused on the precarious state of the registered COMEX inventory. The stage is set for the eternal shift. In the next part, we must explore exactly what happens after. The trigger is pulled, detailing the specific dollar figures Sprott expects, the immediate fallout for the industrial world, and the precise steps you must take right now to protect your assets before the true price of silver, unbound by paper chains, rockets into its rightful valuation. The clock is ticking, and we are running out of time to prepare for the dawn after the paper market breaks. We stand now at the razor's edge, where the theoretical supply crunch transitions abruptly into physical market paralysis. We've established the fraudulent architecture of the paper market, a colossal, unsustainable charade where derivative contracts outnumber the underlying physical metal by orders of magnitude that defy logical comprehension. This isn't merely about bad inventory management. It is a systemic malignancy, a deliberate mechanism designed to suppress the price of an irreplaceable strategic asset. But the facade, sustained for decades by regulatory apathy and the unlimited capacity to print paper claims, is now encountering its ultimate limit, the finite nature of matter. The question Eric Sprott poses, and the existential threat hanging over the major bullion banks tonight, is predicated on the velocity of realization. It is not just about the registered inventory figures reported by the COMEX, which are themselves deeply suspect and often represent metal that has already been pledged or sold multiple times over. It is about the global pool of truly available silver bullion that can be quickly mobilized to satisfy a sudden spike in legitimate delivery demands. And that pool, critically, is evaporating. Think of it this way. The banks have been selling infinite water rights to a rapidly draining reservoir. For years, the actual physical demand, industrial, jewelry, and investment, has consistently outstripped annual mining supply. This deficit has been met by drawing down massive above-ground stocks. But those stocks, the very foundations upon which the manipulators built their short positions, are now critically low. When a major buyer, and we are talking about nation-states, large institutional funds, or yes, sophisticated financiers like Sprott who understands this vulnerability, steps in and demands physical settlement, the illusion collapses. What exactly is the trigger that could happen tonight? It is the moment of default. It doesn't have to be a full, immediate collapse of the COMEX. It could be the first widely acknowledged, large-scale failure to deliver the required metal, resulting in a cash settlement at a price far exceeding the paper spot price. This cash settlement premium, this penalty for non-delivery, acts as the canary in the coal mine. It screams to the world that the paper price is a lie. We are already seeing the precursors to this crisis in the increasing physical premiums charged by mints and refineries around the globe. This Sprott premium, the gap between the spot price displayed on your screen and the price you actually pay for a tangible ounce, is the market whispering its distrust. As that whisper turns into a roar, the paper price loses all credibility. The price mechanism, which is supposed to coordinate supply and demand, has become inverted, coordinating instead the suppression efforts of a few powerful players. Let's dissect the consequences of this initial default, the chain reaction that defines the change for eternity. Once the market accepts that the paper price is fictional and that physical delivery is uncertain, every short contract becomes a ticking time bomb. Margin calls will cascade. Those who are massively short physical silver, the bullion banks, will face losses that are exponentially larger than anything they have managed before, because the true price required to source the physical metal will be unknown, spiking wildly to find a price that halts all industrial and investment demand simultaneously. And here is where the pattern interrupt occurs, reinforcing the permanent nature of the coming change. Silver is not just poor man's gold, it is an industrial necessity. 60% of its demand comes from high-tech applications, solar panels, electric vehicles, 5G technology, advanced medical devices. There is no easy, cost-effective substitute. If the price of silver skyrockets, Samsung still needs it, Tesla still needs it, and the global solar industry, committed to decarbonization, still desperately needs it. Therefore, unlike gold, which can sustain temporary price crashes fueled by central bank selling, an unlikely event now but theoretically possible, silver has a structural demand floor that is increasing year over year. The shift tonight is fueled not just by investment demand seeking safe haven, but by relentless industrial consumption accelerating the rate of depletion. The new price floor, established after the inevitable short squeeze, will be radically higher and fixed in place by unyielding industrial hunger. If you are finding this deep dive into the underlying mechanics of monetary and industrial collapse invaluable, please take a moment right now, hit that like button, and absolutely ensure you subscribe to the channel. We are committed to providing you with the granular detail required to navigate this volatile period. Your subscription is the best way to make sure this critical information gets out to more people who need to understand what is truly happening behind the curtain of the financial markets. The critical turning point, the one that makes tonight the potential catalyst, is the recognition by massive systematic players that the risk of holding a short position vastly outweighs any potential profit. When the fear of infinite loss replaces the expectation of guaranteed profits through manipulation, the game is over. These banks have been operating under the assumption that they can always procure physical metal, or failing that, settle with cash at the suppressed paper price. Tonight, if the delivery failure is significant enough, that assumption dies. This isn't merely a financial event, it's a profound monetary and resource reset. The eternity Sprott speaks of refers to the permanent re-rating of silver against gold and against fiat currencies. For decades, the gold-to-silver ratio has been artificially inflated, trading far above its historical mining ratio, which is typically 9:1 or 12:1. With the paper charade stripped away, silver must mathematically revert toward its true scarcity and utility value. If gold is trading at $2,500 and the manipulation premium is removed, a logical and sustainable gold-to-silver ratio might be 30.1 or 40.1. That implies silver prices of $60, $80 or potentially even higher as a new floor, not as a speculative peak. The climax of this narrative is the realization by the global market that the regulatory framework designed to protect the integrity of the exchanges has failed, and that the only remaining mechanism for price discovery is the raw, unadulterated scramble for physical metal. When the masses realize they cannot buy silver at the current paper price, that the shelves are bare, a panic buying event will ensue that fiat currency cannot solve. You cannot print silver. You can only dig it up, and digging it up takes years, massive capital, and often yields diminishing returns. The true revelation is that Sprott and others like him are not betting on a short-term trade. They are strategically exhausting the available supply precisely to force the market's hand. Their massive purchases and persistent calls for physical delivery are the hammer blow against the brittle edifice of the COMEX inventory system. They are forcing the crisis to happen now, rather than waiting for the global industrial machine to quietly drain the vaults over the next few years. Tonight marks the shift from a controllable paper market to an uncontrollable physical market. The power moves from the centralized clearinghouses back to the decentralized holders of the metal. This is the ultimate payoff for those who held physical assets, understanding that the value of money is guaranteed only by its tangibility and utility. The manipulation ends not because of legal intervention, but because the manipulators ran out of the goods they were pretending to sell. The change in price for eternity means that the metal will be repriced to a level where industrial demand is significantly curtailed, forcing technological shifts, and where new, expensive mining projects become economically viable. This new equilibrium will be multiples higher than anything we have seen in recent history. The monetary role of silver, long suppressed, will be violently restored. This is why vigilance is paramount. Do not look away from the spreads, the inventory reports, and the delivery notices coming out of the major exchanges over the next few hours and days. The subtle indicators of stress, higher margin requirements, unusual trading halts, or the sudden imposition of extreme cash settlement penalties will be the first signs that the fracture has become a full-blown rupture. Prepare for volatility, but understand that this volatility is the chaotic process of moving from a false price to a true price. This movement, once begun, is irreversible because the physical shortage is structural and global demand is increasing. The time for preparation is over. The time for observation and steadfastness is now. Reevaluate your position, ensure your physical holdings are secure, and most importantly, Stay informed. If this analysis clarified the final dramatic phase of the silver market reset for you, please don't just watch. Act. Share this video immediately with 3 people you know who need to understand the true threat of systemic default in the commodity markets. Leave a comment below letting us know where you think the ultimate sustainable price floor for silver will be once this manipulation is finally broken. Engage with the community and let us know what specific resources you are reviewing tonight to prepare for this epical shift. And remember to subscribe and hit that notification bell, because the next update may come faster than you think, detailing the immediate aftermath of this monumental change. The future of global price discovery begins tonight.